Hello, and welcome to our webcast. I'm Amy Pendergrass with Moss Adams, and I'm going to get us started for today's session, a National Credit Union Administration Regulatory Update. And before we begin, I'm going to play a brief video.
Welcome, and thanks for joining us. We're pleased to present another in our ongoing series of continuing professional education webcasts to help companies and individuals conquer challenges as they plan for what's next. Our presentation will start in a few moments. Before we begin, here are a few things to keep in mind. You can customize how you both view our presentation and interact with the presenter. For better viewing, close all other applications and turn up your speaker volume. You can also adjust window size and placement or enter full screen mode using the controls at the top of the window or dragging the bottom right-hand corner to resize. At the bottom of your screen, you'll see a series of icons, each relating to a different aspect of our session. You can download the group attendance sheet and a PDF copy of today's slides from the slide deck and handouts widget to the right of the slide view. You can ask our presenter questions during the webcast by typing a question in the Q&A window below the slide view and clicking Submit. We'll do our best to answer all questions during the presentation or follow up via email. If you experience technical difficulty during today's presentation, refresh your browser by hitting the F5 key. Today's session will offer you 1 CPE credit. To receive credit, you must meet the requirements as specified by the National Association of State Boards of Accountancy. You must attend at least 50 minutes of the session and respond to at least 75% of the polling questions, which we'll ask throughout today's presentation. To respond to a poll, click the button next to your answer. We'll track your progress and alert you when you've earned CPE credit. You can then click the certificate icon in the CPE Progress widget to open a PDF file that you can save to your computer. Don't worry if you can't download your PDF certificate today. We'll email a copy to you in 2 weeks. If you're attending this webcast in a group, you must complete our attendance sheet to receive CPE credit. The attendance sheet is available in the slide deck and handouts widget. Please have all group members sign it and send only 1 sheet per group. Also note that CPE credit can be awarded only to participants registered as themselves and isn't available to participants who view the on-demand version. As a reminder, the presentation you're about to see isn't legal, investment, or accounting advice. We encourage you to seek the counsel of a professional service provider to apply this content to your specific circumstances.
All right. And now I'd like to turn it over to Dustin Barash, partner at Moss Adams. Dustin?
Thank you, Amy. Hello, everyone. On behalf of my colleagues at Moss Adams, we'd like to welcome you to our webcast on NCUA supervisory priorities. We're excited to have you with us today. Our presenter, Greg Marshall, has been a national training specialist for the NCUA for the past 15 years and brings over 28 years of experience with the NCUA to the classroom. Before becoming a training specialist, he was a principal examiner. Greg is a graduate of Gonzaga University, and he and his family live in Spokane, Washington. Please join me in welcoming Greg Marshall.
Hey, thanks, Dustin. Appreciate the intro. Happy to be here. I'd be remiss if I didn't thank Moss Adams. Formerly was McFarland and Alton way back in the 90s. And as a field examiner with NCUA, I had to go into the CPA firm here in Spokane, Washington, and review audit work papers. And I loved doing that. And I would even volunteer for other examiners to come in and review the audit work papers because there was a young CPA that was employed by McFarland and Alton, and I took a strong liking to her. Her name was Macy Bauer, and long story short, Macy and I have been married almost 27 years now, and so I'd be remiss without thanking them for at least that little piece of my life. So let's get started. Let's make sure I get my slides moving here. So disclaimer there on the slide that is required. I'll express hopefully not too many opinions, but if I do, they're of my own and do not necessarily reflect that of the NCUA or the NCUA board. But I do, in my presentations, try to speak the company line, so to speak. So my intent is to give it to you as straight as possible and go over the priorities and then hopefully give you a couple things that will help you in your exam that's upcoming this year and your interactions with your examiners. This is the letter that we'll talk about. NCUA remains committed to focusing our exams in activities that pose the greatest risk. And so this letter, typically we write it every year. This letter outlines the supervisory priorities we have for 2021. And in that letter, there are a lot of hyperlinks that take you to additional guidance and additional information. So after this, if you're seeking that out, just encouraging you to pull that letter up on our website and then click away. You could go down a rabbit hole, but there is a lot of good guidance that's, I guess, linked, so to speak, to that. Okay. The letter also can help you in preparing for your exam. So I'm going to cover those highlights, and then I'll try to dive deeper on what you can expect your examiner to either ask you or what they might ask you for. Bottom line, we understand there's challenges that credit unions are facing because of COVID and the pandemic, and we're committed to responding to those, to that pandemic with guidance, policies, procedures that hopefully reflect the current economic climate that's going on in your area, as well as efforts to increase the efficiency of our supervision program. That continues to be our commitment. And then going into 2021, we are still committed to an extended exam cycle for qualifying credit unions, and those will be scheduled throughout 2021. And then for the smaller credit unions, those are small credit union exam procedures still remain in place for those that have assets under 50 million. And for those that are above 50 million, we'll obviously conduct a risk-focused exam, and we're always concentrating on the areas of highest risk, any new products or services, and then compliance with applicable laws. So with that being said, as a kind of a disclaimer, let's get started. Last year, we had 9 supervisory priorities, and they're listed there. And surprisingly, I won't spend a ton of time on that, but we will look at what's on tap for 2020 on to 2021, 10 items. And I'm going to talk about each one of those as we go through. Just as a high level, I'll try to do a little bit deeper dive on some of those. Okay. So first and foremost is the allowance for loan and lease loss. And a couple things here. Due to COVID-19 and the pandemic, the Financial Accounting Standards Board decided to delay the CECL requirement. And CECL, I think, has been out there in the media or in the public domain and discussions for quite some time. And so because of the pandemic, the CECL requirement has been pushed and delayed till January 2023. So you shouldn't have your examiners trying to determine where you're at in terms of implementation. And they've been advised not to assess any credit union efforts to transition until further notice. However, we still encourage credit unions to continue assessing their needs to evaluate those methodologies for eventual implementation. So it's coming. It's been delayed, I feel like 2 times already. And so examiners will have those conversations with you, but they're not to be looking any deeper than that. They still have to look at the allowance methodology, though, at the exam. So they're still looking at the allowance account in accordance with Accounting Standard 450 and 310, and still needs to consider the relevant and available information when assessing the collectability of the loan. And that's quite interesting given the pandemic, this issue of collectability. So examiners looking at changes in a borrower's financial condition, which is probably more paramount and more pronounced now than I think I can remember. I can remember 1992 when I worked in the Bay Area, and I remember seeing an IOU from the state of California used as collateral in a loan file. And that's about the closest I can get to remembering a time that's as severe as what we're going through right now. However, examiners will be looking at changes changes to a borrower's financial condition, collateral values, economic conditions, all related to the pandemic. All right. So 4 ways in which you can expect the examiners to look at the adequacy of the account. They'll or ask things of you. Number 1 would be the allowance policies and procedures. Number 2, any documentation that you have that supports the methodology, inclusive of any assumptions that you use, and of course, any qualitative factor adjustments that you're using, adherence to generally accepted accounting principles. And then the 4th thing they'll be looking at is any independent reviews that you've had by the supervisory committee or by an internal or external auditor. So that's where we're standing in terms of an allowance account priority. Next one is the Bank Secrecy Act and anti-money laundering compliance. We always look at BSA, AML during every exam. It's like clockwork. Every year at every exam, we're required by statute to look at this. So obviously it's always a priority in every year. And a little deeper into this, NCUA has been meeting regularly as of the last year and a half with other interagency partners. And our effort is trying to improve the transparency and efficiency of BSA and AML regulation and supervision. I remember the first time I went through the BSA AML exam manual, it was a daunting task just to get through the first couple chapters. And so always trying to improve that approach when it comes to examinations. 4 things that were accomplished, at least by this interagency group as of the last year, was 1, they updated that examination manual. In our supervisory letter, there's a link that you could click on that would take you to a PDF file that explains that letter. It's like the preface of the exam manual. That PDF file is 43 pages, which doesn't seem like a lot because the manual itself is, I would say, 2 to 3 inches thick if you printed it out. So once you get to that 43-page PDF, it's full of hyperlinks. And so if you click on any of those hyperlinks, it's gonna take you to the FFIEC page or website that's inclusive of the entire manual. So kind of a heads up or something you can tell your compliance officers if they get any deeper into that. Second thing they issued, back in August of 2020, they issued a joint statement on the BSA enforcement, that's an FYI. And then last October, there was a rulemaking that was developed on exemptions from CIP or Customer Identification Program requirements that dealt with finance loans. I think that has a big impact. And then lastly, this last November, there was a fact sheet that was issued, and that addressed BSA due diligence for charities and for nonprofits, which have been, there's a little more exposure there in credit union land than there used to be. So in line with that, NCUA's continuing to work with credit unions in terms of communicating what they're doing in terms of BSA and what they're doing with other banking regulators and law enforcement. There's 4 main initiatives that are going on right now, and I'll just touch on each of those quickly. First one is doing additional updates to that BSA AML exam manual. So I think that's a good thing for you to know because the BSA review process can be daunting. So continuing to update that exam approach, I think, is good for credit unions. Number 2, working to define what a BSA and AML compliance program effectiveness looks like. Third, getting suggestions and clarifications on how to improve the suspicious activity report and the currency transaction report. They're trying to develop some streamlining in that regard. And then the last thing that's been, I think, in the news a little bit more lately, and it's getting attention. So the financial regulators are trying to take a stronger approach, and that is increasing the human trafficking awareness by providing more information to you all in credit union land and to examiners in terms of helping law enforcement in terms of freezing financial assets in that space. So the reason BSA is such a big deal is because law enforcement, intelligence agencies, and counterterrorism officials depend on timely and informative SARs and CTRs from credit unions and banks, and prompt reporting for any of those 314A matches to help identify and thwart money laundering efforts, terrorist financing, and other activities. And so the more that you can do out there to have a strong compliance program, the better it is. It's not just a, gosh, this sucks, we have to do all these things. It really has a larger national impact. And I think the importance of that sometimes needs to be stressed. So there you go with that. Looks like we have a polling question right away. I'll turn it over to Amy.
All right, thank you, Greg. So our first polling question is, which of the following applies to CECL? A, teller cash balancing procedures. B, ATMs installed in protected access areas. C, estimating the amount of credit losses. Or D, firewall controls. And we will give you a few moments to respond. To respond, please click the button next to the answer you choose and then hit submit. Also, I do want to remind you, if you have questions for the presenters, you can use the Q&A window in your console, and we will do our best to respond to those throughout the presentation. We'll do about 5 more seconds here. Okay, here are the results.
All right, nicely done, folks. Hey, folks, just FYI, you've got to go do 75% of the poll questions, and there's a total of 4. So there's 3 more to go. And if you did this one, then you've got to answer 2 more to be in compliance with the getting CPE credits. I'm just being fully transparent, which Dustin knows that's what I'm all about, right? Okay, great job. 96.8% got that one right. Way to go. That's correct. C is the correct answer. All right, let's keep rolling. CARES Act. So the CARES Act, which was written and signed into law back in March, almost a March and 1 month from today, contains several relief measures for credit unions and their members. And that March 27th, interesting, March 16th was the last day that I was in Alexandria, Virginia at headquarters, and I haven't been there since. And I kind of miss it, but I'm kind of getting used to not commuting. So I like seeing the picture of the Capitol. It kind of brings me back. Anyway, so in 2021, there was an act that was passed called the Consolidated Appropriations Act, and of 2021, that was passed and enacted in December 2020. And basically what that did was it extended several of the CARES Act provisions because the pandemic was continuing. So for exam purposes, examiners will continue to review compliance with the provisions of the CARE Act that suspended the requirements to categorize certain loan modifications as TDRs. That particular provision, which I think has a significant impact to credit unions because it's a lending feature or function, that provision was extended through January of 2022. And so if we were to do some forecasting, there could be a situation where that would even be further extended, again, based on the pandemic. That would be the big trigger there. Examiners are also going to be reviewing compliance with the CARES Act related to recovery rebates from 2020 for individuals. And then there's a couple other items related to the CARES Act that examiners will look at. So I'll mention those. One will be loan modifications. 2 is the credit union's effort in terms of credit reporting to the credit bureaus. 3rd is forbearances. And then the last is that any foreclosures that were conducted in 2020 under a CARES Act provision. And obviously, we've got additional information related to the CARES Act on our website. We had a specific NCUA letter to credit unions, number 20 CU07, that was written. And then a summary of the Consolidated Appropriations Act was written. We put out a letter in 2021. Actually, it was our first letter that addressed that. So there's more information out there if you're seeking that. Consumer financial protection. Obviously a priority for NCUA, and because COVID-19 continues to affect consumers, that increases consumer compliance risk in a certain number of areas. So NCUA will continue to examine for compliance with the applicable consumer financial protection regulations during all the exams this year. And the scope of those compliance reviews is largely risk focused. So it's not one size fits all. It'll be based on the institution itself and the types of products and services and et cetera, any new or emerging concerns in that particular credit union. So if you're talking to your credit union neighbor in the next state over from you, and they had an exam and the examiners looked at X, Y, and Z, I wouldn't expect that to happen to you if you had differences in programs or services or products. Again, it's supposed to be risk focused and unique to your institution. So keep that in mind. And then we're also selecting specific priorities in terms of consumer protection and things to look at based on trends and violations that we see collectively in our exams. We look at member complaints that come into the agency, look for trends in those. And then obviously any recent changes to regulatory requirements. And then lastly, examiners will typically include in their scope how much time has passed since a particular regulation was last reviewed at your credit union. So keep that in mind. Big picture when it comes to consumer financial protection, obviously fair lending is a big ticket item for us. And so examiners in contacts with credit unions will be looking at your fair lending compliance management system. And the system really is a way to, put a title to certain things that you're doing already. And so more specifically, examiners are going to look for board and management oversight when it comes to fair lending, policies and procedures that address fair lending, the training of your staff when it comes to fair lending, and then monitoring and corrective action if you find anything in terms of violations, and then how you're responding to any member complaints when it comes to fair lending. So that's consumer financial protection. And looks like we have another poll question, Amy.
All right, so our second polling question is, the CARES Act contains provisions for credit unions because of blank. A, the Bank Secrecy Act, B, the COVID-19 pandemic, C, the change in interest rates, or D, none of the above. And we have had some attendees asking for copies of the slides, so I just want to let you know that you can download them now from the slide deck and handouts window, and then we'll also be sending them out tomorrow via email along with a recording of the webcast. It looks like almost everyone has had a chance to respond. Okay, here you go.
All right, nicely done. Yep, CARES Act provision because of the COVID-19 pandemic. The CARES Act was written in direct response to COVID-19. So 93.7% of you, nicely done. Let's keep rolling here.
Greg,
next priority.
Greg, I had one question. Pop up, if now I can jump in. All right. Yeah. So the question was, it says, I believe that the CARES Act guidance states that a cumulative total of 6 months is the maximum to grant a payment deferral modification without causing the loan to be reported as a TDR. So if a 2-month payment deferral is granted, then later a 6-month payment deferral is granted for a total of 8 months, then the second payment deferral can be a TDR, right? So it's a very specific CARES Act question.
Well, to give you a straight answer, I would have to look it up to make sure I gave you the best guidance possible. So my gut tells me that if you're reading it, interpreting it, I would, if it was you and I on a discussion, whoever asked the question, my answer would be, give me a chance to look that up and make sure that we're on the same page. There are too many, honestly, too many provisions and too many different things floating around in this small head to really pull the clarity up on that particular question. So if there is a question, I always encourage you to reach your examiner and ask them specifically that, and if there's additional guidance. But at this point, that'd be the same thing. I'd say, give me 15 minutes to look it up. Good question, though.
Thanks, Greg.
Because what it tells me is that you're wanting to do the right thing and report it the right way, and I appreciate that. So I would want to give you the best guidance by looking it up. And if I didn't see it being clear, then I'd push it up the ladder to a regional office or to our legal counsel to get you the best advice. Okay. Let's roll. Credit risk management. Okay. So NCUA is continuing to encourage the credit unions to work with your members affected by the COVID-19 pandemic. Obviously, some credit unions are impacted more than others based on the state that you're in or the type of demographic that you serve, definitely what your field of membership looks like. So NCUA is reaffirming that examiners are not going to be criticizing your efforts to provide prudent relief for your borrowers when such efforts are conducted in a reasonable manner with proper controls and management oversight. So I want to repeat that because I think it's pretty important. And if you don't feel like that's happening, then I would encourage you to pull this supervisory priority letter up and discuss it with your examiner. But examiners will not criticize credit unions' efforts to provide prudent relief for borrowers when such efforts are conducted in a reasonable manner with proper controls and management oversight. And I think that's the thing that examiners will be looking for is what are the controls that you have and what is the oversight that you're providing so that you are providing good relief to those borrowers. So in that light, there's 5 things that examiners will be looking at. And so number 1, your loan underwriting standards and your credit risk management procedures, and how those standards and procedures were changed to help provide the relief. Number 2, any adjustments to your program to address borrowers facing the financial hardship because of the COVID-19 pandemic. And I would say you've got to do your best effort to show what those adjustments were and how you're addressing the borrowers. Number 3, your policies that address the use of your loan workouts and what those loan workout strategies look like, the risk management practices that you're using, and then anything that's new that you've implemented to provide funds to borrowers impacted by COVID. I know some credit unions have offered new programs or services, some new loan types to address COVID specifically, and so that would fit in that space. In particular, the examiners, and this is something that I preach and teach to a great depth in the classes that I teach new examiners, is you've got to be evaluating the control environment or the controls that management has in place. That's number 1. Number 2, the reporting function. And then number 3, how those programs get tracked. And so I call that oversight. So the things that we're asking examiners to ask you about is, what are your controls? How are you reporting it? And what's the oversight over that program? And then fourth, in this area, is whether you've evaluated the potential impact of the COVID response and relief on your own credit union's capital position and financial stability. So we're asking examiners to ask you if you can demonstrate that you understand what's happening with those COVID relief efforts and that you're evaluating the credit risks specific to that. We've got stimulus checks is on the one side, and then we've got the forbearance or these relief efforts on the loan side. So we have a balance sheet issue, really, inflow of shares, and then relief efforts in terms of loan repayments. So it really comes down to, can you tell your examiner how you're monitoring that balance sheet and then projecting the particular risks involved out into the future. And then lastly, any risk monitoring practices that you have, they should be commensurate with your complexity. I was teaching in a class last week to some 20 new examiners that we hired, and we had a deep discussion on COVID-19 specifically that addressed those two issues, how the influx of stimulus money is impacting total assets and how that's causing the net worth ratio to drop collectively. And then what's the extent of forbearance or payment relief on the left side of the balance sheet in terms of loans, since loans are typically the biggest asset for a credit union, and the reliance on that income stream. And so we had a very deep discussion with these new examiners on basically you need to have conversations. I'm telling them you need to have conversations with the credit union folks that you're examining, and to make sure that they're understanding both sides when you're talking about COVID and the impact. So that's the side on credit risk. I kind of jumped on to a little bit of liquidity there, and I'll follow up with that later on. The next one is...
Greg, we had another question that's still in the credit realm. So if you're okay, and I think it's in addition to the research that you might be doing on the last question. It says, similar to the previous question, I have heard of credit unions being criticized by examiners for not downgrading any member business loan granted a deferral to watch. And if the accommodation goes beyond 6 months and the borrower does not have the ability to resume normal payments, the loan needs to be converted to a TDR and downgraded to at least substandard. Please include this when you check your resources. So it's essentially with some feedback from examiners specific to MBL deferrals.
So in response to that, I will tell you what I tell the examiners in my classes. And I tell them this: hey, I'm talking to people in credit union land. I'm talking to CEOs and CFOs in these types of conferences, and I'm telling them to tell you or ask you, hey, examiner, can you support that position? And so I'm telling you that right now. When your examiner says, hey, I'm criticizing you for not marking it substandard or X, Y, and Z, I encourage you to come back to them and say, can you show me or give me the guidance or the citation that I can use to apply in my daily operations? And I tell the examiners, you cannot go on this, that's your feeling or that's what your belief is. You have to provide the credit union the citation and the support. Just like if I'm a field examiner, I would ask the credit unions, hey, support what you say. If you are telling me this, I need you to support it with some documentation, some analysis, et cetera, so I can evaluate that. And I think it goes the same thing on your end. I'm telling you, ask your examiner that question as well. Hey, examiner, support what you say. Give me the citation. It's not a fight. I don't want to have a disagreement or a debate. But if you're asking me that it needs to be marked a certain way or reserved a certain amount, give me the guidance so that I can use it and apply it in a broad range rather than just one specific case. And if the examiner can't do that, then I think you have a situation where you have to get into, I guess, not the weeds, but go into depth on, well, if you can't, hey, examiner, if you can't provide a citation, then why are you telling me to do it? Right? So I tell the examiners in my classes, I'm asking you all to challenge them and make sure that you guys are on the same page with the same type of guidance, and not just because it's a personal feeling. And I guess that's my best roundabout answer to that particular question, Dustin, if that makes sense.
Yep. Thank you.
Yeah. The examiner should be able to provide you the background and what they're using to support their position with you. Okay. IS&T, Information Systems and Assurance, also known as cybersecurity. This has been a huge thing and close to me, really. And really, it's about these emerging cyber attacks, this persistent threat to not only credit unions, but the financial sector as a whole. The likelihood of these affecting credit unions and the consumers just is increasing. And it seems like it's exponential in terms of increase because of a couple of factors. One, the advance in financial technology. Two, we're seeing, obviously, with COVID-19 pandemic, the increase in a remote workforce. I can attest to that. I am strictly a workforce person that's been in a remote posture for over a year. And then third, the growing adoption of the mobile technology for financial transactions. Venmo was one that my daughter brought to me like 9 months ago. She's like, Dad, let's do the Venmo thing. And I'm like, this has got to be some new tech. And I had to look at it and try to figure out, is it safe enough for my daughter to be using with her credit union account? And so NCUA continues to promote this cybersecurity hygiene that we call it, and review of information systems and assurance programs will be a pretty significant priority for our agency this year, and I would say in subsequent years. Last year, we were using and talked about a tool called the ASET, and that stood for the Automated Cybersecurity Evaluation Toolbox, and that was being used in exams. And now we've moved to piloting a different type of review system, I'll call it, called INTREX, and that stands for Information Technology Risk Examination for Credit Unions. So INTREX-CU. And what that does is it really harmonizes the IT and cybersecurity procedures for an exam that are shared by the FDIC, the Federal Reserve System, and many of the state regulators. And so what we're trying to do with that is to establish a consistent approach across all, with these other regulators, a consistent approach across all the community-based financial institutions. And INTREX will continue to get deployed in credit union exams in 2021. And that hopefully allows examiners and credit union staff to identify and address potential high-risk areas in security program deficiencies. That ASET tool, the ACET, that will become for us a self-assessment resource for credit unions that we will support. And so additional information, obviously, on our website in our cybersecurity resources area will address that.
Hey, Greg, we had a couple additional questions come through, but I'm going to hold those till the end just to make sure that you can keep the presentation going, and then but I'll get those at the end. Thanks.
Okay. Next one. This is a repeat from last year. The LIBOR transition. Examiners and NCUAs continuing to encourage the credit unions to get prepared for this. The discontinuation of using LIBOR ends at the end of this year, 2021. And so if your credit union has LIBOR-based transactions or any LIBOR-based contracts, we're just hopeful that you are not delaying your preparations for transitioning away from that benchmark. Can be significant. It's a complex undertaking, and we understand that. It's been on our radar and conversations during exams for over a year now. And we'll just continue to educate the credit unions on that transition. And if I was to take a poll right here, or if we were in person, I'd probably ask for a show of hands that those of you that have already addressed it, hopefully everyone would raise their hand and say, yes, this is a done deal. And that you can show your examiner that it's just not an issue. But if it continues to be, then I'm also pushing that point that time is running out for that transition that ends at the end of this year. And we've got some we've got an assessment workbook available on our website that helps in terms of planning in that transition. And then back in July of last year was an interagency statement that had guidance that dealt with LIBOR. And another poll question, Amy.
All right, thank you, Greg. So our third polling question is, Intrex is an examination tool NCUA is using to help assess A, cybersecurity, B, ATM cash loading procedures, C, Bitcoin value fluctuations, or D, impact of gas prices on loan repayment. And just a reminder, you need to receive CPE credit, you need to respond to at least 3 of the 4 polling questions.
Greg, I'll try to get one of these questions in now while folks are answering. This one is there an expectation by examiners for credit unions to formally adopt a cybersecurity framework, NIST, CIS, for example?
I try to listen to all the words in that question, Dustin. And when you say formally adopt, like, yes, examiners want to see it formally adopted. So that's a board review, board passage, motion second carried, and then something in writing. Now, what does that framework in writing look like? It has to be tailored for the institution itself. And so examiners want to come in and they want to see, yes, formally adopted. What that really means is the board is on board. The board is aware of what the cybersecurity posture is and what management is doing. And then it gives the examiner a chance to evaluate that. So formally adopting, absolutely. Does it depend on the size of the institution? Absolutely. So I can paint you a picture of a credit union that wouldn't really need a cybersecurity program because they aren't touched by anything that's security related in that space. And then I could paint you a picture of a credit union that has a significant cybersecurity exposure. So every case is different, but would we look for something that's formally adopted? Absolutely. Because it shows board of directors and officials awareness. When there is a program, but the board isn't aware of it, then it just doesn't, the transparency isn't there really in the oversight. So in terms of our polling results, we're doing great. The majority of you are on the correct answer was A there. So nicely done. Let me keep moving. Okay, I mentioned liquidity risk earlier, so let me follow up on that. Obviously, COVID-19 and the pandemic has resulted in an increase in volatility, I'd say, on share balances on the right side of the balance sheet, and then loan demand and loan losses on the left side. So the stress on the balance sheet could potentially require increased level of liquidity management through this year and possibly into 2022. So the uncertainty that exists, NCUA is just encouraging credit unions to broaden the range of their scenarios when they do their projections. I talked about this last week in the class that I taught the new examiners. We talked a lot about financial projections, and the main point I tried to stress to them was you want the credit unions to do their own projections, and then you have to evaluate the scenarios they use in the projections. So having projections is great. Then what are the scenarios you're using? 25% share runoff, 50% share runoff, 25% stimulus influx, et cetera, et cetera. So I would say your examiner should be asking for those things from you. So if you can provide them different scenarios for your projections, that's the direction we're taking here. And then in terms of analyzing your liquidity risk, there's a couple things that analysis should address and that your examiners will be looking for. One, how does a sudden and significant share outflow impact your liquidity position. Can you handle that? Sudden and significant are very fluffy, ambiguous terms that we all use. And so any definition you can provide just makes your stuff better. Second thing would be a broad range of possible interest rate paths to identify variability in loan and security cash flow. Right now, interest rates are low. They're not expected to increase, but if you did some scenarios where you had interest rates going up and showing projections on how that impacts your cash flow would be good. Changes in your cash flow projections based on other relevant factors, field of membership impacts, employment impacts, etc. And then obviously the effects of loan payment forbearance, loan delinquency, projected credit losses, all things that are, I think, quite difficult to project and forecast given COVID-19. We just ask credit unions to do the best that they can. You know, there's no standard out there other than you got to try to do your best. And then a couple other things, decline in credit quality because the market value of assets decline. And that declines because of a borrower's capacity to repay. That's related to unemployment. And then stress scenarios that include maybe a reduction in your available line of credit to provide you liquidity off the book. Again, additional guidance available to you. We have actually the examiner's guide on liquidity risk would be where I would turn you in that regard. Next item would be serving hemp-related businesses. I'll make this one relatively quick. NCUA is encouraging credit unions to consider whether you're able to provide financial services to lawfully operating hemp-related businesses within your field of membership in a safe and proper way. We issued a letter, so that's a continuation. I know the state of Washington has hemp-related businesses that are being served by credit unions, and so it's going more of a nationwide. Also, there's a definite Bank Secrecy Act and anti-money laundering flavor to this. And so that additional guidance letter 20 CU19 would be something I'd encourage you to take a look at. Now for some internal stuff. NCUA last year and the year prior, we began piloting this NCUA Connect is what we call it. And we also began piloting our new exam tool, which is called Merit, which stands for Modern Examination and Risk Identification Tool. NCUA Connect is our secure entry point for documentation and connection. And then because of the COVID pandemic, we're delaying the rollout of that and any training efforts that we had planned. And we're going to try to do that in the second half of this year. I had a meeting about it yesterday, in fact, and the second half of 2021 is what we're expecting. I can't give you a specific date, but I at least give you some awareness that if you're getting an exam maybe in the later part of this year or early next year, it's likely that you'll be being exposed to that new exam tool called Merit, or you'll hear your examiner mention Merit. And then there's a little bit on the examination planning questionnaire. Well, got too fast there. We used an exam planning questionnaire before. Now we're trying to incorporate that in the planning process itself and hopefully help you provide examiners with information on certain things that's happening in your institution that helps the exam process become more efficient and effective. And so be on the lookout for a questionnaire in that regard in advance of the scheduled exam, and then the examiner will be using those responses to refine their scope, increase any monitoring off-site that they can do, and then try to incorporate some efficiencies into the exam itself. And that takes us to our final poll question, Amy.
All right, so our last question is, which of the following items are related to the NCUA's modernization efforts? A, increased frequency in-person on-site examinations. B, streamlined typewriter ribbons. C, pagers with LED lighting. Or D, NCUA Connect and Merit.
I wrote a good poll question there. That's good. I'm going for 100%.
Yeah. Greg, here's I think a quick question while we're waiting for the answers to pop up here. Is it anticipated that remote exams will continue post COVID-19?
The general expectation is that will, I guess our approach will change. That's the best way I can say is the approach will change. And obviously it's health and safety of not only credit union people, but also our examiner staff is always part of that decision-making process. And every state in our country has a different exposure level and vaccination deployment, et cetera, et cetera. But I think what we're seeing in terms of our approach to exams, given our offsite posture, is we have capabilities. Can we deploy those capabilities and make them more mainstream? And if so, what does that exam approach look like? We're very aware of what it's been like and how we've had to pivot and change when the pandemic hit. And now we're seeing is, we may be in that some type of exam approach that leverages technology and offsite review more and more. I just don't know what that looks like, because I forecasted that COVID would be over in 3 months. That was my initial forecast. And that was just between me and Macy and how it impacted our kids at school. So I just don't, I think it'll be different. So, okay, we're at 93.9. I think we got 1.9% that I would enjoy an adult beverage with, because I think they're funny. Because pagers with LED lighting, I don't know if those even exist at all. So I dig that. I dig this group. If I saw you in person, I'd tell you that face to face. All right, my last slide that any commentary from me is this. Our new chairman, Todd Harper, has been public about his 4 priorities. And so I just want to reemphasize those. I had the opportunity to meet with him on a few occasions. In fact, a couple weeks ago, I got a chance to speak with him for 10 or 20 minutes in a class. And he's continuing to iterate, this is his priority: capital and liquidity, obviously for our credit union system. He's a big proponent of consumer financial protection, as you can see in our priorities letter, cybersecurity, and also diversity, equality, and economic inclusion. He's probably, of all the chairmen, the NCUA chairmen that I've got to work under, he's very down to earth. He's very approachable. He likes to be called Todd. It's been really refreshing, the approach that he's taken as our board chairman. And I just wanted to reiterate what his priorities are and how they definitely, as you can see, align really well with what the supervisory priorities are for our exam approach this year. And with that, I know that you have many, many thoughts. Hopefully you had some thoughts over the last 50 minutes. We're at 53 minutes, so you all get your CPE credit as long as you did your 75% of your poll questions. And if we had additional time, I'd probably want to dive in with each of you on those thoughts. But I will, with this last slide, if you have questions or concerns or comments, I just encourage you to just ask your examiner. Having a relationship with your examiner and regional office is really important, I think, to the exam process and definitely to our supervision process. And so call them up, email them with your questions, and get that dialogue going. Also, here's my contact information. If you need additional information, what I'll likely do is try to turn you into the direction or point you in the right direction of someone that can help you probably more significantly than I can. But I know quite a few people, and I think I can get you headed in the right direction, or I can answer your question directly. Give me 24 hours to respond. And if you end up emailing me, if you call me, I probably won't answer because it'll look like you're a phone solicitor, and I'll let it go to voicemail. So leave a good message on who you are and what you're calling about, because I tend to not answer because of the robocalls. And with that,
so Greg, I have a couple questions from the last few minutes that we have, if that works for you.
For sure.
So and I'm going to just go back here a little ways. Okay. This one may be maybe put in the same space as the first two specific loan-related questions. With forbearances, what is the expectation in regards to having a specific loan loss reserve for those loans in forbearance?
Well, I've heard about a couple different approaches. One that most commonly is if you look at impairment pools. So going back pre-COVID, where credit unions would have a pool of loans of similar risk characteristics. Let's say used vehicle. They have a pool of used vehicle loans. And so I've heard about credit unions identifying or creating a pool of this is a pool of loans that are vehicle loans in forbearance versus a different pool. These are vehicle loans that are not in forbearance, and then addressing impairment that way. Now, I believe, and correct me if I'm wrong because I'm not the CPA, but I believe GAAP would allow that type of approach in terms of creating, basically segregating out a specific loan pool into two different types of pools. One that this pool is all forbearance loans and this one isn't. And so I've seen that. I've been hearing about that is probably more common. Hopefully that answers the question.
Great, thank you. The next one is, when asking examiners for guidance, how does this affect findings? There was an interagency statement on the role of supervisory guidance not being a law but a recommendation.
Yeah, I saw that, and we talked about that amongst our instructor staff. And I would say, like, can you repeat the question, Dustin? I want to make sure I give a good answer here.
Yep, let me scroll back down to it here.
Okay.
It says, when asking examiners for guidance, how does this affect findings? I'll leave it at that part of the question there. Yeah.
When asking examiners for guidance, how does it affect findings? When examiners write findings, they're instructed to write findings and provide a citation or support for the finding. Now, that's how it's been for quite some time, even when I started. So now we've got this, is whatever the examiner provides as a citation, is it a regulation? Is it a NCUA letter to credit unions? Or is it considered this quote unquote guidance? And that's where it gets fuzzy and gray. And I think the conversation is not over yet. And I think I'm hearing some examiners are struggling with that, particularly some of our new examiners, is what do I use? Because of this issue of what is guidance versus what's a specific reg citation. And so I think the best way to get about this is just to have a very good dialogue with the examiner and saying, okay, what's the support for this? Does it make sense for our credit union? Does it make sense? What angle are you coming at, or what direction are you coming at? And get to, reach an agreement with the examiner, whether it's a finding. I always told credit unions, findings aren't bad. Having an examiner finding is not bad in an exam report. It's just something that the examiner came across and wants to document it in the written report and show that it's something that needs to be addressed. And if they can also show that management addressed it during the exam, then great. I mean, perfection is not the goal. Perfect effort maybe, but again, effort comes with flaw. And so I would say findings are not necessarily bad. And that's the examiner / instructor point of view. I worked at a credit union before I joined NCUA, but I was a teller and not for very long. So it's easy for me to say that. It's easy. It's harder for you to implement it or have that. that's my,
Thanks.
I guess, long-winded to that question.
Okay. I think we have time for one more. Is there a methodology or reasonable estimate to forecast outflow of stimulus deposits?
That's a great topic to dive into, because I would, if I'm the examiner, I would typically ask you for your historical cash flow data and your projection. I would look for your projections to be based on historical cash flow experience. And so with the pandemic and stimulus checks, there is no history to go back to, right? And so if I'm your examiner, I would just tell you that. I'd say, hey, there's nothing that you can use experience-wise. And so let's look at different scenarios like this. What if 5% rolled off? And start just starting at the base of using a percentage. If you're in Alaska, however, I think you could build a case for, Alaska has the, I call it the oil checks. The oil profits the direct deposits happen at the end of every year. And then credit unions in Alaska can show when that money comes in the next day, and then can typically in their cash flow history can show at what point they all roll out or at what percentage they roll out. And so I think Alaska has some sense of that, or what that seems like, this immediate inflow and then the exodus of that over time. But there really is no history with the pandemic stimulus checks. The best thing I could do would say, if you have any specific member that had got a tax refund over the last 5 years, and you could track how that tax refund came in and then what percentage of it rolled out. But that's a deep data dive, and I don't know if it's worth the time. So I would say, because of that, I would be reasonable in the exam approach and say, let's just start using 1, 2, 3, 4, 5% and see what those forecasts look like. And then try to make it reasonable based on the field of membership. If they're blue collar and they live paycheck to paycheck, I would expect that money to roll out. If it's primarily savers in the field of membership, then I wouldn't expect any of that money to leave quickly. If that's the scenario.
Thank you.
Yeah.
Okay. Amy.
All right. Thank you, Dustin. And thank you, Greg, for a great presentation today. And to our audience, we did get several questions. So if we didn't have time to answer your specific question, we will do our best to follow up with you after the webcast. And also, if you met all CPE requirements, your certificate is available to download now in the CPE progress window. We will be emailing a copy within 3 weeks should you have any difficulty downloading it now. And here is a link to an online survey for today's presentation. Please take a moment to complete this survey, as your feedback is very important to us. And thank you for joining our webcast. We hope you'll join us again next time.